Big banks in the red today as the XLF, the ETF that tracks the financial sector, flirts with correction levels. Our next guest has an outperform rating on many of the major banks. So is this an opportunity for investors? Let's bring in RBC Capital Markets Managing Director Gerard Cassidy. Gerard, great to have you with us.
Thank you.
I think we all know what the bull case is supposed to be for financials. How come the trade just simply has not worked? And at what point do you say, it's not going to work, maybe I should switch my ratings?
Yep. I would say that the macro outlook is what's changed, particularly with this trading situation that is going on about the trade wars and the whole markets are down. I think that's what's obviously weighing on the banks. We have two big events coming up. This Thursday, we're going to hear the results of the stress test for the banks. Next Thursday, we're going to hear from the Fed about how much they're able to give back in dividends and buybacks. We expect big numbers next week, and I think that's going to be very positive for the banks.
When you look at all the systemically important banks in the world as defined by the Financial Stability Board, there are 30 on there. 50% are in a bear market. I mean, to Melissa's point, the economy's good, unemployment's low, supposedly interest rates are going up, supposedly they're going to return dividends. If they can't go up now, when are they ever going to go up?
Yep. There's certainly a big run since the election. As you know, the banks have been one of the best performing sectors. Recently, they have pulled back, as you mentioned.
Down 20% since January.
Yep. And I would say that there's been more sideways in terms of some of the fundamentals that some of the macro numbers have said. But real GDP now, as of today, is calling for 4.7% real GDP growth in the second quarter. If we come in with a north of 4% real GDP growth number, that's very positive for the banks.
But will we see that in loan growth? Will we see that in trading volumes? Yeah. Will it translate?
Yeah, no, that's the point, and a very good point. And actually, in loan growth, since the first of the year, it's starting to pick up. It's currently now running around 4.5% year-over-year growth. But it's the second half of the year that people are anticipating stronger growth. If it doesn't show up, then the stocks will certainly suffer.
Do you have, among the big banks, a favorite? And I note that you have an underperform on Wells Fargo.
Sure. I would say the favorite is Bank America. Bank America is the one that could benefit the most from the strength in the U.S. economy, assuming it comes through. The Wells Fargo underperform rating is obviously because of the issues that they're wrestling with the regulators right now, and that's weighing on the stock.
I assume that you've had the outperform on Citi, JPM, Bank of America, Morgan Stanley for quite some time.
That's very true.
So you mentioned at the beginning of the interview that the outlook around the world has changed. We're seeing a slowdown or a slower growth in Europe, et cetera. At what point do your ratings then reflect what has changed in the bull case for the banks?
Sure. If you go back, we went very bearish on the banks in January of 2007. And the reason we did was because of the outlook for credit was going to deteriorate. Credit quality is single-handedly the #1 destroyer of bank earnings. We don't see any issues with credit. So when we start to see issues with credit, it will clearly change like we did the last time. So we've been bullish on the banks for quite some time. And so we're anticipating this credit cycle is the best we've seen in quite some time. And with the consolidation of the industry that's coming, we think that's also going to support the banks in the next 12 months.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.